Welcome, ladies and gentlemen, to yet another issue of the Grey Market Talk with my fabulous friend, Nicholas Themistocles. It is Nicholas, actually, Nick, is it?
Nicholas, yeah.
Nicholas. I also thought it could be a Nicholas. Anyway, portfolio manager extraordinaire. And I have a couple of questions today, actually, for you, Nick, especially that we are running now, well, out of the first quarter into the next quarter. And as you managed huge portfolios, huge, big ones, really big, sizey, big portfolios, what's happening around quarter ends? Then we look at the markets and well, I found a couple of interesting slides. Obviously, that's the whole motto of Hussman funds. Recommended. Have you seen them? I follow them on Twitter or on X, how it's called now.
Yeah, they have some very good, really good research. I mean, obviously, their view on the market is different to what the market's doing, but nevertheless, they are very intelligent people.
I was on their website and copied it in for later. 3 fantastic quotes he dug out from 1929, from 2000, and the nifty 50s also, 87, the 70s period. Anyway, I open my screen. Let's start straight away. Share. Grey Market Talk 31st, and happy Easter to you, Nick, and to all of you who are listening on this day to us. It's always a question, are people actually watching more YouTube videos or reading interesting stuff on Easter, or they're not doing it all? What's your take on this?
Well, I mean, it's not Easter for everybody. I mean, as a Greek Orthodox, we celebrate Easter a little bit later. But you know, my view is this is usually a good time for the family, but it gives you also more time to do some YouTube watching or podcast listening to. Or things
you always have to be different, you Greeks, don't you?
I am actually. I mean, this time it's, you know, I keep coming up with this time it's different, but of course, every Easter it's different for me.
I remember that the first time I was in Athens, I watched the changing of the guard, which is quite a spectacle, but I was absolutely surprised about the military attire they were wearing and the guards. And I honestly, it's so long ago, I'm not quite sure. You know, our friend from, shall I say his name? Lysis. You know our friend Lysis, he used to be in the guard, and I was a teenager when I was in Athens, and I watched that, and later on we had a conversation. He's Carl's godfather, and I thought he must have been in the guards at the time when I was on holidays in Athens. So, tiny little word. Huh?
Indeed.
Yeah, no, fascinating. Anyway, Grey Market Talk. That was actually, do you see still my screen?
Yes, I do. It's visible.
Good. I can't see it now. Now I see it back again. So, concentration, that was the Hussman Strategic Advisors Fund. And I like this slide. Came out on X last week. And what does it show us? The median price to revenue ratio of the 10 largest S&P 500 companies, 1231 in annual data, and the median price revenue ratio of the 50 largest S&P 500 components, same date. And what we can see here is this huge spike on the concentration of the 10 largest S&P 500 companies. And when we look at last week's figures, we are totally in Goldilocks reflation scenario, Nick. Is that correct?
We are in lower inflation, and we are in, well, yeah, I mean, we are in, I would say it's sort of on the border between Goldilocks and reflation, because, you know, I still have my doubts as to whether or not growth is increasing or decreasing.
Yeah, what was it, 3.4 GDP?
Yeah, but the nowcast forecasts are sort of coming in with a 2 handle for Q1, and therefore, given that we had a 3 handle for Q4 last year, then the rate of change is lower, and so could argue that, you know, are we really truly in the reflation territory, or are we sort of bouncing back between reflation and Goldilocks? I mean, the most important thing for markets is, you know, is there growth? And yes, there is growth. So talk of recession is sort of way off the table nowadays than what it used to be. And so top half growth, whether it's sort of stable or whether it's rising, I think is at the moment less relevant.
I find it fascinating how fast a narrative we are talking about here every week is flipping from higher for longer, inflation is dead, then now we are having inflation again, stagflation is a topic again. How long is that ago, Nick? 3 months we were pricing in 6, 7, 8 rate cuts for 2024.
Absolutely.
Now they seem to be completely off the table.
Yeah.
Next week we have Fed meeting again. We have CPI, we have PPI. Do you expect anything big from these numbers coming in, or is it again a no-show?
No, I think this, rather than saying this is sort of no surprises, I would say, and I think it looks like we're coming into a sort of kind of a low volatility world. And if you look at fixed income, for example, as you rightly say, at the beginning of the year, 6, 7 rate cuts on the table. Now it's 2 or 3. Well, with 2 or 3 rate cuts forecast, that the kind of the range of where interest rates are likely to be. Whereas if you look this time last year, people were still on the view, are we going to go to 6 or 7 or 8%? Because look at the Taylor rule and all of this stuff. And now the ranges of forecasts becoming more narrow, and more narrow means less volatility. Less volatility is actually sort of a good thing for investors. Yeah, I mean, you don't want too high a volatility in anything you buy. And if you look at the MOVE index, which represents the volatility of the bond market, that's coming down quite sharply. And that's, as I say, a good thing also for the bond market. But it means that the range of movements are becoming more narrow. I won't say more predictable, but certainly in a more narrow range. And that's a good thing.
Especially as you're mentioning the MOVE. We discussed that a while ago on the show when this huge spread was between the VIX and the MOVE. And we discussed it even. There are 2 ways how markets could behave. Either the VIX picks up, or the MOVE has to come down eventually. I always thought the bond guys are more clever than the equity boys, especially when we're talking about volatility. This time, then, it seems that the equity boys got it right. Subdued volatility in the equity markets, bond market got it wrong. Yeah, let's have a slight drift to the downside again.
Yeah, and I think it's as I said, that's a positive thing. It's a positive thing for liquidity because it means collateral values are worth a lot more when there's lower volatility. At a time where liquidity is actually sort of a little bit tight in the system, it is supportive, but perhaps it's not supportive enough, and that's a different topic. But I think the most important thing, recession is certainly off the narrative table, and the bond markets look at the moment as though you could predict where the sort of December 2024 contract is likely to be, within plus or minus 25 basis points, which I think is a good thing.
Brings me to the point, the question I actually mentioned in the intro. You managed large portfolios, about a huge variety of assets. What is the typical scenario, or is there one at all? You always hear the myth of the rebalancing. Now we have quarter end. What's usually happening in houses where institutional fund managers, money managers like your good self, are sitting there? Are you actually getting active? Is the end of a quarter a big thing? And if it is, what's usually happening there, Nick?
Yeah, there is, what rebalancing means is changing the allocation of your portfolio back to what you thought was your strategic allocation. So if you thought at the beginning of the year you wanted, let's just say, 50% equity, 40% bonds and 10% gold, and then over the period of time, suddenly the equities were worth a lot more, the bond was worth a lot less, and the gold was unchanged. Suddenly your allocation would look like, let's just say, 60% equities, 30% bonds, and 10% gold. And what a rebalancing means is that you'd move your equities back to what you think is your strategic allocation. So you'd be selling your equities 10% in order to get back down to the 50%, what you wanted. If you were at 60 now because price has gone up, sell 10% to get to 50. And your bonds, which have lost value, you'd be buying an extra 10% of bonds in order to sort of then have at the end of the year or at the end of the quarter your strategic allocation. Now, if you're going to do a rebalancing at the end of a quarter, we do it for our investors at the end of the year. But if you do a rebalancing at the end of the quarter, and larger funds, as you rightly say, do that, they would also have at that same time a strategic discussion about what the right allocation should be. So they wouldn't just, say, okay, let's rebalance to what we decided last quarter. They'd have a look at it again and say, is that sort of 50, 40, 10 allocation correct? Or should we be doing something else? And whatever they decide for the new strategic allocation, that's what they would rebalance to. And as you sort of rightly intimate, well, it's a quarter end, equities have done a lot, bonds have done something, but they've not done a lot, gold has done a lot. So what do you do at the end of the quarter? And I think a lot of, there's enough calculations out there to say, well, people have to sell X billion equities and buy X billion bonds and so on and so forth in this rebalancing. And that, you're absolutely right. That's what goes on at the end of the quarter.
So there is let's call it twofold way. There is a discretionary part where you have to readjust what do we think the markets are going to do for the future and do the rebalancing accordingly. Have been most of the guys out there been caught down with their pens down, not being invested in the equity market because everybody had a slightly bearish view on the economy. And as the market has proven all the bears wrong, at least on the equity side, and also the bond market slaughter seems to have been over. Will there be, on the discretionary side, reallocation more into equities? The first part of the question. Second part, you mentioned volatility. That's a mechanical part of it. The less or the lower the volatility is, the more you as a fund manager, if I get that right, have to invest because your clients are paying you for, risk-weighted investment. Yeah? They can hold their cash on their own. If volatility goes down, you actually will have to take your equity quota or your risk quota up, or am I getting that wrong?
Well, okay, first part of the question was what was to do with, we're at the end of March. Is it likely that we're going to see those people who have been short the market for, last year and the like, suddenly having to come in? And my answer to that is, my view is, and I think we talked about it at the beginning of the year, that a lot of these Wall Street advisors told their clients at the end of December that they changed their mind. That actually, you know what, there's not going to be a recession. And you know what, when we told you not to buy equities when it was 3,500 because it's going to go to 3,000, you should now at 4,500 buy equities. And I think what happened at the end of the year was a large rush into the equity market. And I think that's why you had this kind of acceleration point. Elliott Wave guys call it the point of recognition, I guess, where suddenly all the bears become bulls and they all kind of realize, oh, shoot, the market's going up and it's not going down. I'm on the wrong side. I need to be on the right side. So they also, and I think that moment happened kind of at the end of last year, somewhere between that last 2 months of the year, certainly at the end of last year or the beginning of this year. And so I don't think there are too many bears left, to be frank with you. I mean, obviously, there's some tactical bears, looking to sell the market. But I think the strategic investors, the kind of the institutional type investors are probably fully loaded at that point. And the next part of the question was volatility. Well, if volatility goes down, fund managers say, well, I'm being paid to sort of make some money. There's some low volatility. I should be able to take a punt here. Well, yeah, I mean, it's kind of right what you say, but how is that exercised? Fund managers always have this discretion to move a certain amount of money into cash, and the time that they do that is sort of generally when they either before or when they start to see volatility increasing. So they don't want to be caught wrong-sided because, as you say, that if the volatility was 30%, that's a 2% swing on a daily basis, roughly. And so that's quite a big amount for a fund manager to deal with. So he would be at that stage kind of maxed out as to how much cash he's going to have on the side. And when volatility starts to go down, there's less reason for him to kind of have that cash on the sideline. So as volatility decreases, he can handle the day-to-day movements the day-to-day swings, and so you see money moving from cash back into the markets. And the point about the move index was more to do with, since 2022, when they started jacking up the rates, nobody knew where interest rates were going to land. There were sort of forecasts of 8% plus, and nobody really knew. And so the market had to find that level. And in finding that level, you had a huge amount of volatility. And the move index went to 150, which is the equivalent in bond language of about 15 on the VIX or thereabouts, which is a great deal for a bond trader. And, now the market's kind of found its way, and it's sort of saying, okay, we're not talking about 8 rate cuts, it's 2 or 3, and they're kind of happy with that. The volatility has kind of come down, and people feel more comfortable in a low volatility environment to invest. It's not just, forced because they've got to make some money, but you feel more comfortable if there's less volatility to put money to work, because, you're not going to be, put money in today and then suddenly it moves 3 or 4% against you, and suddenly, it's a year's worth of income gone. Whereas if volatility is down, you can think, okay, I can start to ease money into the system, and I don't really need to get the timing right.
So if I bring these 2 points together, as you said, that probably the discretionary part, the reallocation, started in December of 23. That is an explanation, obviously, why we see new all-time highs in the S&P. They've changed their investment style. They shifted into, let's get all in. At the same time, as it usually is, markets go up, volatility is falling, volatility is at subdued levels, which means they have been able to put even more cash in the markets and leave less on the sideline. Which brings me to the next question. If everybody is now invested and the cash reserves are relatively small, that surely is exposing us for higher risks in the next quarter to come, right?
Sure, absolutely. I mean, if we go back to last week's little chat on Elliott wave, each of these 5 waves has a personality. And, if you think that, we've been going through a very powerful wave in equity, and that's sort of, let's just say, the middle part of this whole sequence, the wave 3. Wave 4, the psychology of wave 4 is actually called surprising disappointment. And it's surprising because, people have just figured out the markets are going up. They say, I was bearish at 3,500. I got in at 4,500. Whoopee-doo. Market's gone up a few hundred points from there. And oh, shoot, the market's gone down again. How is that? And that's the surprising disappointment in a kind of a wave 4. And it could well be that, that's, in my view, that's kind of where we are in the market right now. Looking for that sort of area for the peak, always difficult to time, and looking for some kind of corrective pullback. And I think you're seeing it in tech. I think, we started with Magnificent 7 and it's gone down. Apple looks awful. Microsoft, which was looking okay, is looking, it's not going anywhere. And suddenly it's these other investments, other global markets and small caps, which are sort of attracting some attention.
Yeah, absolutely. That actually sets me up for this, the other part of the Husman quotes, which he pulled out there. Fantastic. One is about the 29 boom. Was in fact quite a narrow and selective one. It was a boom of the handful of stocks that figured in the daily calculation of the Dow Jones and New York Times index. The time of the robber barons, of the radio was invented, of the assembly line was invented. There you had the big concentration. Then the next one is a Nifty 50s, 1977. The Nifty 50 appeared to rise up from the ocean. It was as though all of the US but Nebraska had sunk into a sea. The 2-tier market really consisted of 1 tier and a lot of rubble down below. Reminds you of something? We've seen that, right? And then 2000, the time we were already sitting in economy stocks and the old economy stocks. I remember that a good friend of mine asked me for a recommendation. He had a huge portfolio. I was in, don't hit me with it, 99 to the end of 99. He said, Thorsten, what shall I do? And I said, you know what? Get rid. That's when I actually stopped giving recommendations to friends. I said, get out of all this crap. Most of it will be worthless at one day. And park your money in good quality stocks, yeah, good German, big assets. And then the market did another 30–40%. And I had him in my house every day complaining. He sold it and blah, blah, blah. You know the game, right? 2 years later, when actually happened what I said, the Neue Markt had lost 95%, and a lot of the companies he was holding beforehand were bankrupt now.
Sure.
Do you think I ever heard a thank you? No.
Yes, of course. I mean, you're never right. Yeah, that's true. I mean, I also, had friends at the time saying you need to mortgage your house, you need to put it in this Neue Markt. Well, okay, obviously we know where that ended up, and it was a good lesson for people, not to gamble too much,
Well, I
even
think
if you think it's a sure thing, whatever it is.
the question is, we're again at this stage now. Yeah, this time it's different. I don't know. Nobody said it now explicitly, but it's the mood. Nobody can actually, especially the younger generation. Markets also have an institutional memory. All the guys who followed up, yeah, no, they're 10, 15, 20 years younger than we are. They've never seen a bloodbath in the market. Even 2008 seems to be a faint memory for a lot of the guys who are sitting in front of the screens now. They can't imagine that investor attitude or assumptions can shift quite dramatically. And one of these things underlining, because it reminded me of the 2000s, I mentioned that before, but it's too good to not to repeat. Sir Templeton was once asked, he was still living in the Bahamas, well in his 90s at the time, and he timed the top of the new economy perfectly. And he was asked by this reporter, how did you do that, Sir Templeton? And he said, well, it's actually, we had a lot of new millionaires suddenly in all these companies. So we looked at the blackout periods, when were they allowed to sell their shares? Yeah? And we timed it when they started selling, we started selling, because they wanted to stay millionaires. And the human nature never changes. So we didn't have to look at valuations or anything. We just wanted to see when are the boys who are owning the companies actually want to keep their wealth. And then I called this slide the little rascals because, well, it went through the papers, yeah, from Jeff Bezos to Zuckerberg to Thiel, everybody and its stock seems to sell billions worth of stuff at the moment. I had a little video out with Jimmy Demon, where I think it's a special situation. Yeah, the man is about to retire. He wants to lock in some of it, and he's never sold any of his shares. And it's only wealth if you actually have it in cash to spend on it. Yeah? And if you have to buy who owns the biggest yacht? It is Bezos, isn't it?
Most likely.
Yeah. So these guys are selling massively, and that's a chart from the Financial Times. Sellers to buyers are the red bars, which have picked up dramatically now in the first quarter, and the blue line against it is the Nasdaq. Where you see, obviously, these boys, why are they selling shares now when they could have another billion or two extra? First of all, if you have a couple of billion, maybe it doesn't matter, Nick. Does it matter? You have a couple of billion?
Well, I think as a percentage of your money is probably more important than just a couple of billion. But yeah, you're right. I think I get the point.
So yeah, timing-wise, it's always the question. That's why I found our conversation last week about Elliott Wave extremely useful, because the writing is on the one side, yeah, economy, the numbers they did show us, look, yeah, fine, somewhere between Goldilocks and reflation. Then you have these other anecdotal evidence, and then you have the market mechanics we just discussed a little bit earlier. Yeah, all the marginal buyers might have gone into the market. There might not be a lot of money on the sidelines. And at the same time, you see the assets that have been bought over the first quarter were actually sold by the boys who own them.
Indeed. I mean, obviously, this is, if you're looking for sort of reasons to sell, and Templeton found a lucky hit. I mean, you can see from this chart here, it's only a 10-year chart, but you can see it's very difficult to use just one signal here to say that's the signal I'm going to use. But I think it's just indicative to say, yeah, if you had your checklist of things to look at and say, what's the things that point to a red flag, I guess this would be one of them, and that makes a lot of sense.
What was that word again? Surprising disappointment?
Yes, surprising disappointment.
I've learned something new again. I love that. So, because that was one of my slides, I just slipped it in again here, the aktuelle Lage. What we see in the papers, especially in Germany and the major US sheets. If you want to watch that video and you speak German, well, I think it's quite entertaining. It's only 8 minutes. And I was just waiting. Only Man of the Year, unfortunately, only comes out by the end of the year in Time magazine. But that was a fantastic indicator. If one of the big boys has been made Man of the Year, and I'm not talking about the frauds here, I'm talking about sensible guys like Elon Musk. Just get out. Bezos in 2000. Just get out. Doesn't mean the company goes bankrupt, but there is slim pickings ahead of you. And this is, well, the conversation I get a lot at the moment. I remember that when did Bitcoin had the first super rally up to 6,000? When was that? 2 years ago, 3 years ago?
Oh, timing wise, yeah, it must be 18 or 2008. No, that's wrong. So wind back. That must be before that, 16 or
Yeah,
2016.
because I remember that the young Italian lad from Sicily, waiter next door in the restaurant, came over. I'm there every Saturday and said, Senor Thorsten, I wanted to become a Bitcoin trader. What can you recommend? And at this time, having never invested myself in Bitcoin, I knew party must be over. If something like that happens, it reminded me of when the baristas are starting selling volatility. Uh, I don't know, Nick. It's we have to do another session on Elliott Wave, getting into the other some of my favorite markets. Gold is definitely
Very important.
on the card
Absolutely.
now with this breakout. Especially one of the takeaways I took from last week was this: if this impulse wave starts, it's practically an unstoppable force. Yeah. Have we seen this in gold? Would your interpretation be that we have seen a new impulse wave there?
Yeah, I mean, commodities behave slightly different to equities. So, this fear and greed. Greed is what powers the equity market, but fear is what powers commodity markets. And so commodity markets tend to kind of peak in a this big bull wave, if you like, or this is the final wave in commodities. Is where everyone is so frightened of not having something, copper or gold or whatever it is, that it actually sort of forms the most powerful wave in the fifth wave, as opposed to equities. It's the third wave. So we have been in seeing these impulse waves in gold, and the moves down. This is a great chart you've got in front, because you can see in the middle of the screen all of this overlapping kind of stuff, right in the middle at the time where everybody was kind of forecasting a recession between 2002, 2003. All of this overlapping stuff, you can see is corrective because it overlaps. When it doesn't overlap, when you start to get sort of this sort of higher highs and higher lows, and that's what you see in you've been seeing gold for a while. That's when you know that you're in the trend, and these other things are just corrective waves. When you see overlaps, it's corrective. You don't really see overlaps. That's the impulse wave.
You've just mentioned fear and greed. Obviously, I'm requoting now the other market hero besides your good self, for me, Jeffrey Gundlach. He said there are three motivations. Greed is very strong, when fear is stronger. But the strongest nobody ever talks about is need. What does an investor need to do? And coming back to the gold chart, I thought, okay, what if we would go into this framework of what needs some of the guys who are strong in the gold market, when they're in the gold market, need to do, talking about the central banks here, obviously, they need to buy gold, don't they?
Yeah, again, go back to like the first few videos in May last year. Central banks across the world who, if they're oil producers or whatever, China producing all of their, dollars from exports. What do they do with their dollars? If you're an oil producer or if you're a big exporter, in the good old days, you used to just buy treasuries, but you don't do that anymore if you're a foreign central bank, and partly because your fear is that you might get sanctioned, they might freeze your assets, and the Russian thing was a good lesson in that. But this began a long time, 10 years ago, I would say, when central banks started to rethink what do they do with their dollars, because they could see very clearly that the path of debt in the States was just to increase debt, whereas the coupon was staying very low. So if you had reserves of your country, you got very little interest, and you had an asset which was just an endless supply in the hands of US. So there was already a gradual shift to different types of assets, and therefore gold becomes much more important these days if you're a foreign central bank than it ever did before. So Jeff Gundlach is right. They need to diversify, and there aren't that many things that you can look around the world and say, okay, I can buy that, or I can buy that if I'm a central bank. You won't see central banks generally buying Bitcoin. Some do, El Salvador, but generally they don't, because they don't want to sort of say to their people, look, we bought this stuff with your money that nobody in government really understands. So generally for government, they would rely on gold, and as I say, that's just something that you see central banks doing these days. So they have to.
Let me finish with I'm doing a new share here.
I've got the fear and greed up there.
Yeah, fear and greed. Obviously, nothing much has changed. We are still in the in greedy territory. I wanted to share one of our homemade tools we are using just to show off a little bit. Can you see this now in front of you? Seasonality is actually quite interesting. Seasonality in March should have been actually bad, and it wasn't. And now, if I take the historical charts, we should come into the top 3 periods of outperformance in April for the S&P. And let me quick flick over. That's one of the other tools we like to use on a rolling basis. It's the performance of, in this case here, the S&P, and I've taken 90 days. So to get the data, the historical data is simply, we're looking at every 90-day period over the last 20 years, to get a lot of data. And then we look at the returns. If you would have randomly picked every day in the past and then waited 3 months, how was your performance? Then we took this, take averages out, and what you can see here is simply the standard deviation against itself over all these points. And we are now at a standard deviation of 1.123, which is already in the territory. If I look at the upside, where only 15% of all performance we've seen should be. And then we simply take this and adjust it. If it only go back to the normal performance we've seen, we would now for the next 90 days expect an S&P performance of minus 7.75%. Obviously difficult. We are at a new all-time high, and we just at the economic data. But if I have the chance to look into the statistics, say, okay, March didn't work on the seasonalities this time, but April allegedly has been strong. And we have now seen an outperformance beyond 1 standard deviation. So we are already on very thin ice. Our prediction would be that it is time for pullback, taking this all together. And then I call it always a bit sleight of hand, because yes, you need to come up with one number. But I like the 7.75% potential return, minus 7.75% potential return to correct this little greed cycle we've been. Your take on that, Nick? Is it all a bit hocus pocus? Or...
No, I think that's highly plausible. There are 2 ways you could do it. You could say, if you're looking for a tactical move now, do you just sell this thing and say, well, look, Torsten said, reversion to the mean, or reversion to some, where this thing should normally trade. You could just do that. That wouldn't be necessarily a dumb view for many people who like to sort of take that pick the high kind of view. On the Elliott wave, it's in that range for me. So therefore, again, I'm looking for this thing to be in a kind of a wave 4 sideways correction, surprise, the disappointment for those people who just got into the market and then they say, well, hang on a minute, what's going on? So that also makes sense. But I still wait for my signals. I have these signals which I've developed, and they are still saying to me, it looks like you're close, but it's not right there yet. I mean, last time I spoke, and I think the time before I spoke about S&P to gold ratio, and that really is on the edge, and that usually is a good warning signal for trouble ahead in the equity market. So, the things I would look for are S&P to gold to already send me a signal that has actually turned down, and that would be a good advance notice. You looked at insider selling. That's another signal that you'd use. I mean, and your toolkit here, which has basically said, this isn't necessarily the greatest time to buy the market because this is what you're vulnerable to. So all of these things point to, hold off if you're looking to invest. If you're looking to sell, I mean, you're the best at that. You have to explain to people how exactly to sell, with minimizing your risk.
Yeah, or we're all again in 99 again. We have another 30% to the upside. Yeah.
Yeah, I mean, there is always that. As I say, I am not necessarily bearish for equities longer term, but I still feel that we've got to have some kind of correction. And it may well be that we've had a correction. It's just so minor we didn't even see it. It's one of these little squiggles on the chart. You say, well, that was it. I mean, I hope not. I'm sort of thinking that this thing should be a little bit longer, a little bit deeper, should surprise a few people and give other people a chance to get back into the market. But yeah, I'm looking for what you're predicting in your analysis.
With these fine words, let's finish off. And I didn't tell you. I want to spring that also next week. There will be no gray market talk on Sunday because I shall be traveling with my daughter, who is applying at a variety of universities. So I'm on the road. Then we'll see you in 2 weeks' time. Sorry for that, but there are some things that are important. Suddenly we get a house back. Yay! Oh, well, you've been there. So thank you very much, Nick. That was very enlightening today, especially the conversation about what happens on quarter end, in which current situation we are in. And to all our viewers, I wish you again a beautiful Easter weekend, and we shall see you then in 2 weeks' time. Thank you very much. Bye-bye.
Thank you. Bye-bye.